in many ways, financial barriers and opportunities that can get in this space are quite significant. For those who haven't had any exposure to the lab before, just a bit of a background as to who we are. So we're a not-for-profit company, and we're interested in exploring real-world challenges that climate change poses to local economies, to the environment, the community, and the stresses that are put on government systems, the research needs that we need to basically make the most of quite a changed environment, and that it will affect us across all levels of government, all sectors of society, and the broader community as a whole. Our webinars are organised in a fairly structured way, so that participants can engage in a new topic with a climate change expert every fortnight, and subscriptions are across the whole organisation, so they're a great opportunity for you to bring in other people within your organisations to learn more about particular aspects of climate adaptation. We're fairly new to the webinars game, so when we launched them only a couple of months ago, we weren't 100% sure how they'd be received. We just had a hunch that councils might be willing to engage in it, and that we may have something that is a valuable offer for councils and that is relevant in their day-to-day work. As we find our feet in this space, we understand that our perception and our ability to reach other people is constrained by the newness of our organisation, and so as a result, I really would encourage everyone who's taking part in this webinar today to give us some feedback on what we're trying to do, to help us generate ideas that we can act on, and to encourage others like yourselves to participate. So, even though we're running the webinars, we do see this as a two-way process. In terms of today's session, we've got Ian Edwards on to give us run this webinar about finance. The driver behind Ian's presentation is that if we're effectively to adapt to climate change, that we must work out how that's managed by the private sector can be tapped into to help achieve that. Private sector capital is not freely given, and capital is very much interested in the what's in it for me question, so where's the profit? And so there's a real challenge in this space of moving thinking from the climate adaptation needs funding to answering the question as to how do you finance climate adaptation. So the objective in this webinar is to look at that relationship between funding and finance, particularly in the context of local government, and ultimately at how each of the components and how councils can use that to enhance their capacity to manage climate change. We're not going to run through details about all different financing mechanisms. That's a fairly immature space, but I'm sure Ian will have a lot to say, which will be of interest to most people on this webinar. In terms of introduction to Ian, Ian's a chartered accountant with over 20 years' experience. He specialises in climate adaptation and this wonderful area of alternate risk transfer and adaptation to the private sector. I'll admit to being completely bamboozled by that line. He's worked across a wide range of industries, including public practice, investment banking, and reinsurance. His career is focused predominantly on affecting systems change at multinational scales, and this has given him a great insight across a range of areas in the analytical, financial, information technology, and project management skills. Ian's recently completed a master's dissertation at Griffith Uni, and his research explores the viability of risk transfer mechanisms in the face of increasing climate risk within the context of local government. So I think Ian's recent research might be particularly useful to most of the people who we've got on the webinar today. So without any more ado from me, I'll hand over Ian to present the webinar.
Thanks a lot, Rod. I really do need to update that bio. Things have moved on a lot since then. The Masters was actually finished about 4 years ago. And I've been involved in a lot of differing sort of projects and initiatives since then. But yeah, I certainly do have a strong interest in insurance and alternative risk transfer mechanisms to insurance. And I think Sophie from Cairns actually provided some questions in advance to Ian Morrison around insurance. And I apologise in advance, Sophie, because I'm not really looking at insurance per se in this presentation. What I wanted to do was I wanted to look at more the debt side of financing and also how the relationship between financing and funding to basically enable adaptation activities and the capital and whatnot that's required for that. But listen, thanks, Rod. Thanks for the introduction. I much appreciate it. I think everyone knows enough about me, and I've had a little bit of a spiel there. But just before I start, can I ask that people submit questions in the chat line down the right-hand corner as we go? I've got quite a lot to cover, and I'll look to answer those questions at the end. And for the questions that we've received in advance, I think I will cover most of those, but if I don't, other than the insurance, I'm sorry to say, but if I don't, please let me know, and I'll certainly address them at the end. Now, listen, a quick caveat around adaptation finance. To be honest, it's an incredibly novel field. The private sector is really just getting on board with what adaptation is and how they may get involved. So there's not a great deal of understanding out there of what it is and what it means. So I guess what I'm trying to say is I will certainly talk about adaptation finance today, but what I would like to do is I would like to broaden the discussion and consider the drivers of affordable finance and also the drivers that can enable funding. So I want to look at the relationship between funding and financing from a local government perspective. Anyway, to do that, I'd like to start with, what's going on here? Some key concepts. The first concept is the concept of expenditure, and the reason I'm telling you this is to lay some background. So when I sort of move into some other topics later on, we're all on the same page. So excuse me if I'm pitching too low, but this is important stuff. Now, if we talk about adaptation activities, one thing we know about adaptation is that it's certainly we're going to have to pay for it one way or another, and adaptation activities are quite broad. We potentially have adaptation around the asset or the plant and equipment space. So, for example, we might want to build some sort of seawall. Now, that's typically considered something along the lines of capital expenditure, and that's where we've got a big chunk of money generally on a one-off or something like a one-off basis, where we're acquiring something and we expect the services from that something that we acquire to be provided across a long period of time. On the flip side, we've also got what we call operational expenditure, and that might fit into adaptation where, for example, we want to engage a climate coordinator or something along those sort of lines, or it might even be additional repairs because of the stresses of extreme weather on our asset base. So the thing about operational expenditure, that's a little bit different to capital expenditure. It's typically small. There's small amounts and they're paid at periodic times. So we've got capital expenditure, we've got operational expenditure. The definite relationship between both is we need to find monies to enable us to make that expenditure. So, the big thing here is expenditure equals dollars. Now, why am I telling you this? If we look at expenditure, this slide that I've got on the screen here, this purple box of expenditure. We've got this distinction between funding and finance. So if I can distinguish between the two, and the way that I'll be using the terms in this particular webinar, funding is essentially the provision of monies with no expectation of repayment. So from a local government perspective, it can be all sorts of things. It could be federal grants, interest, fines, and the biggest one across local government in Australia is what's known as own source revenue, which incorporates your rates and your user charges. So you're receiving monies potentially because you have provided a service, but there is certainly no expectation that you will be repaying those monies you've received. Now, that if we compare that to financing. Financing is very different. Financing, we receive money, but there is an expectation of repayment. And beyond that expectation of repayment, there's also an expectation of some sort of compensation. So if we look at a loan as a classic example of financing, I'm paid principal. When I repay that loan, I also repay interest. And that interest is that compensatory element. Now, the predominant sources of financing for local government, well, I'd have to say local government in Queensland, it really is just a QTC, the Queensland Treasury Corporation. But the other source that's available out there is the commercial banks. So I just want to quickly, this diagram here, I just want to make it very clear that financing is no silver bullet. The other relationship between financing and funding is financing, as I said before, has to be repaid back. And the only way that local government can repay that financing back is through their funding stream. So that's an important element. Ultimately, you need to pay the ferryman. Now, I just want to quickly finish these key concepts with one other element here, and that is the cost of financing. So as I mentioned before, there is this compensatory element that's included in, or an expectation in financing. And there are a number of things that drive that. And these things that drive it are important because they'll determine essentially how much or the level of that compensatory element. So let's talk about interest again and a loan. Essentially, when we're talking about finance, quite simply, the greater the risk, the more the compensation will be demanded. And if we're talking about a loan, we're specifically talking about something like credit risk, or it's also known as counterparty risk. And that is the risk that the borrower will not repay the lender when the monies are due. So the higher the risk that will occur, the more interest, for example, that will be demanded by the lender. The other interesting part is the novelty and the complexity of the mechanism. The thing about, and a lot of people don't realise this, but the thing about the financial sector, the services it can provide are really quite flexible. And if we talk about financing mechanisms, for example, I was once asked to put together a typology of financing mechanisms. And to be honest, that's almost a possibility. It's almost like how long is a piece of string? Because the financing sector can essentially structure a mechanism to meet any requirements. Now, when we think of financing, we often think of loans or insurance, which are very vanilla, standard sort of mechanisms. But if you get the structured financing people involved, they can do anything. Now, what that means is, or the important distinction around that is the more novel and the more complex a mechanism is, the more it's going to cost you. And that's something you might want to consider if, for example, if you're starting to sort of think down the lines of some funky, innovative financing mechanisms. They're probably going to cost you more. So let's talk about resourcing adaptation. And a lot of what I'm about to show you is my view. So I also want to caveat that this webinar around that. And it's come out of work that I've done for a number of clients where I actually have looked at adaptation finance. But the big take home for me right from the start is, as we know, climate change, it's the mother of all pervasive risk. Its scale and its scope, it can pretty well impact everything. And I think if you want to look at finance, or if you want to look at how you resource certain activities, you need to start with funding, certainly in the local government space. So I want to use Queensland as an example. So if we look at if we look at funding sources and the way that that's regulated in Queensland for local government, it's essentially, certainly own source revenue, and as I mentioned before, being potentially or predominantly rates and user charges, is regulated by the Local Government Act and the relevant regulations. Now, with respect to how those rates or those user charges can be set, there are a number of principles which are provided and need to be applied. Now, the idea of these principles is to actually ensure financial sustainability. So in other words, to enable the council to maintain its financial infrastructure capital over the long term. And over the long term means basically at least 10 years, so beyond 10 years. So what it means, these principles are all about ensuring that when we set the level of rates, as an example, we're thinking in the long term, and we're trying to determine how much we need and how to apply that to levels of rates. So, the main ones I want to concentrate on here, and I'll be very quick with this, is rates practice principles. So fairness, equity, meaningful contribution, predictability, and user pays. Now, with climate change, we know that climate change is going to impact, or it's going to cost us more into the future. So I guess these principles to me are a compelling reason to ensure that we are incorporating and we're trying to understand what the implications of climate change to our operations and our capital base is as soon as we possibly can. And I guess what I'm trying to say is these principles to me are essentially a compelling reason to, as soon as possible, really start looking at risk managing climate change and incorporating that risk management process as deep as we can in our processes. So that means that the impacts of climate change will flow through to our forecasting and our projections, and they can help meet these principles. As an example, I think a classic is predictability. Predictability is all about ensuring that when we set our rates, they're not bouncing all over the place, and our ratepayers have an understanding or have a relative confidence that they'll be able to meet those rates, so they know what they're going to be. The earlier that we can incorporate the impacts of climate change into our projections, the smaller those changes can be, and the more we can smooth them over time. So as an example, if we expect, let's talk about a seawall again, to fail in 15 years as opposed to 30 years, we can essentially incorporate the additional price of that 15-year replacement in 15 years' time right now, and we can smooth it out across our rates base. If we leave it to the last minute, we're either going to have a blip, a special levy, or we're going to have to go out and find finance to do exactly that. So that's my big first take home. Okay, let's get on to financing adaptation. Now, when I was asked to look at climate adaptation financing, to be honest, I was really quite bemused because I thought to myself, well, how is climate adaptation financing, or how is financing adaptation activities any different to financing any other activities? If I've got a seawall and I was going to build it to 5 metres, but now I'm going to build it to 10, in respect to the finance that I'm seeking, does that really make any difference? I'm really just going and asking for a bigger amount. But as I hunted around and sort of dug into this space, it became quite apparent to me that there is a good reason to brand any initiatives that you're undertaking in the adaptation space as adaptation. And that's because of what we're looking at on the screen here. What we're looking at is the growth in what's called sustainable finance. And as you can see, from 2007, around sustainable finance, there was $1.5 billion sustainable finance issued globally. In 2018, that was almost $250 billion. That is a significant exponential increase. And what this is showing is it's showing that there is a demand amongst investors and financiers out there to finance sustainable initiatives. And of course, climate change adaptation certainly fits the bill. It is a finance initiative. If we bring it closer to home, Queensland, Victoria, and New South Wales have all issued in the last 3 years what are known as green or / climate bonds, and they are an integral part of sustainable finance. Indeed, T Corp, which is the New South Wales government's Treasury Corporation, their green bond was subscribed to $1.8 billion. So they raised $1.8 billion, but $2.4 billion was actually subscribed. So in other words, there was $0.6 billion that actually wasn't needed. So there's great demand out there. The other thing is all of the big four banks all have right now policies around how they want to apply monies to climate-orientated solutions. So they're actually putting money aside and saying, look, this bucket here, we want that to go towards climate change, or we want it to go towards sustainable solutions. Excuse me. Now, why is that important? Because if you're looking to finance an adaptation initiative, then really, if you can brand it as finance, then you're essentially positioning yourself where you can access finance which is not available to other initiatives. So, for example, if you're out there and you're basically building a dog park, then what I'm trying to show on this slide here is that's a generic type activity. You can access traditional finance to do that. I mean, not that you would, but you certainly can't access climate or ethical finance. But if you're doing something which you can brand as adaptation and it's accepted as such, it opens up this whole new path of finance to you. The thing I should have mentioned actually around ethical, sustainable and climate financing is it is quite prescriptive around how those monies can be spent. So, for example, the bond that was issued by the Queensland government, I'm pretty sure it was a climate bond, was issued pursuant to the standards of what's known as the Climate Bond Initiative. It's a climate bond standard, and it's quite prescriptive, and it does allow for mitigation initiatives and climate change adaptation initiatives. But if you're out there building that dog park, well then, no, you're not going to pick up this sort of finance. Excuse me. The next thing I wanted to talk about, and I think, Sophie, I'm hoping this might cover one of your questions, is around, okay, I mentioned before around the compensatory element of finance and how much you actually pay for finance. And one of the main drivers of that is risk. Now, right now, I can pretty confidently say that climate risk is not really impacting how much organisations pay to access finance. But I think there are a number of significant trends in the private sector which are going to change that dynamic very, very soon. And I mean, it could be quite soon because things are moving so rapidly. And I just wanted to take you through that because this is important to understand that if you're looking to access finance at any point from the commercial sector, and this even applies to someone like QTC, who you probably access your finance from now, but they're going to be under the same sort of ringer if they're going out to the market for their finance. These are the sort of powers that are starting to play. So I'd like to start in the bottom right-hand corner if I can. And what I've got there is I've got the regulators, the financial and economic regulators of this country. So we've got ASIC, the Australian Securities and Investments Commission. We've got APRA, which is the Australian Prudential Regulation Authority. They're the guys who are responsible for regulating the financial instrument. And then we've got the Reserve Bank of Australia. Now, in the last 3 years, and certainly increasingly so over the last couple of months, all of these institutions have released strong statements around their concerns of climate change as a systemic risk to the financial stability of the country and the broader economy in general. And if you look at ASIC, for example, ASIC and actually APRA also have released statements saying that we will look very closely at those organisations that we regulate to give us confidence that they are, one, taking climate risk seriously, and two, where relevant, they are managing that risk. So in other words, if we look at those corporations or those organisations sitting in the circle in the middle, we've got the big four banks and we've got the big insurers in Australia. They are all receiving pressure from the regulators to be looking and managing climate risk. The next pathway of pressure, if you like, or the next pressure point is from the top right-hand corner, and that's the investors. So the investors being the likes of local government super, for example, I think is a classic example, and conglomerations of investors like the Investor Group on climate change have come to the realisation that climate change is actually a risk to the financial return that they will receive from their investments. So they are putting pressure on those that they invest in to ensure that they are managing climate risk and that they can show that they are managing climate risk. So, for example, if I'm local government super and I'm tossing up whether I'm going to invest in ANZ or NAB, NAB has a great policy around climate risk. They're doing a lot of really good work. It's obvious they're managing that risk really nicely, and ANZ don't even acknowledge the risk exists at all. My money's going to go to NAB. Now that, once again, is a great motivator and incentive for the financiers of this country, and this is right across the globe, by the way, to take this seriously. Now, the third element that I quickly want to talk about is up in the top left-hand corner. That's the Task Force on Climate-Related Financial Disclosures. That was a task force that was initiated by Mark Carney, who's the head of the Financial Stability Board, the G20's Financial Stability Board, just after the Conference of the Parties in Paris back in 2015. Now, the TCFD, as it's known, is all around providing a framework to enable corporations to disclose, one, their exposure to climate risk, but also how they are managing that disclosure. So what we've got is we've got these requirements on the right-hand side, around return and systemic risk. But on the left-hand side, we've now got the framework that enables that. Prior to the TCFD, I think the initial issues paper that was released identified, I think it was like 400 frameworks that could be applied to climate change disclosure. And all that was really doing was creating a lot of obfuscation, confusion. The TCFD creates a level, standardised playing field, which enables investors to basically compare between differing organisations in respect to how they are managing their climate risk. Now, the fourth one is this mild-mannered chap down in the left-hand corner. That's a fellow by the name of Noel Hutley. Now, Noel Hutley is a Queen's Counsel, and he released an advice back in 2016, which has recently been updated a couple of months ago, around the fiduciary duties of boards of directors with respect to climate change. And essentially his advice is this: if you sit on a board of directors and you don't understand what the impact of climate change is for your organisation, and you're not generating the governance and the risk management systems that ensure that that risk will be managed appropriately, you are not fulfilling your fiduciary responsibility as a director, and you hold yourself out personally. So this is not the corporation, this is you personally, for negligence/tortious legal action in the future. Now, if I'm a director, that's the last thing I want to do. So what I'm trying to say is these four pressures are putting a lot of pressure and a lot of incentive and a lot of motivation on the financiers of this country to look at climate risk. Now, if I'm a financier and I'm going to look at climate risk, the climate risk that I hold is predominantly assumed by the clients that I deal with. So what this means is, and this is the bottom little arrow pointing down to the consumer, this starts to flow down to the consumer. If I'm ANZ and I'm going to provide a 30-year mortgage to an individual, before I provide that mortgage, there is incentive now for me to understand what that particular house is going to be like in the next 5, 10, 15, 20, whatever years. Is it going to be increasingly exposed to extreme weather events? Is this going to degrade the quality of the asset? So there is an incentive to look at the organisations and the people that I'm lending to. So that I just wanted to sort of raise, because this is coming. The main barrier to this at the moment really is technical and its capacity. But the banks and the insurers are all working on that. And as I say, this is moving so quickly, it really is only a matter of time that the financiers in this country will be taking a very close lens to climate change risk when they're assessing whether they'll lend or whether they'll insure. So probably think I'll bounce all over the place, and I know this is not specifically an adaptation finance presentation, but I just wanted to join the dots, because really what I'm trying to do is I'm trying to make a case for the inclusion in climate risk management as deep as it possibly can be within local government processes. And that's because, as I showed in the funding, the sooner you can incorporate that, the sooner it has the potential to provide a positive influence on how you set your own source funding. The sooner you can incorporate climate risk management, if you can show the insurers and the lenders that you are managing this risk, then by all intents and purposes, that really should reduce the risk to them, which should reduce the price that you are paying. As I say, it's not happening right now, but the trends are all moving and pushing very, very much in one direction. In closing, the only other thing that I've done there is I've drawn the arrows in all different directions, the blue arrows, and that's because everything is related. Quite often you need insurance to access debt. Sometimes you need to access debt to enable you to create a capital spend to enable insurance. And depending on how you manage your funding, that will drive the size of your funding debt and potentially how much financing you need to go and access. So listen, I'd like to close the formal presentation at that point. I'm just going to see if I can have a look at the, let's have a look what questions we've received here. I think they'll pop up here. Will banks be less likely to lend money for investments in coastal hazard areas? I mean, that's come from Ian. Well, yeah, I honestly think they will. If we look at the trends that I just mentioned, those coastal areas which are exposed to climate risk and don't have any mitigating elements that reduce that exposure, I would imagine that there will certainly be an incentive to look very, very closely. And I mean, the money may come, but I think the real potential is that the amount of money or the amount of interest that is demanded could increase a lot, to a point where, quite frankly, the finance would become, for all intents and purposes, unaffordable anyway. Okay, I'll just see if I've got any other questions here.
A few there, Ian.
Right. Sorry, Ian. Something's happening with the question list. That's not. You might have to go there. I'll jump in. A lot of the questions look like they are coming from me, but actually they were submitted in advance. Thank you to everybody who did that in advance. Now I'll jump.
Do you want to just ask me the question, because I'm having trouble getting at the.
Yeah, absolutely. So what questions can the CFO be expected to be asked, or should be asking themselves in the next 1, 5, 10 years of that financial planning horizon that you mentioned?
Well, I think it harks back to the slides. If we're talking specific to climate change, I mean, climate change is just another factor that needs to be taken into consideration when we're considering our forecasting and our projections around expenditure and capital outlay. So I would think, if we're talking around climate, it's that. It's what impact is it going to have on my capital base? Do I need to increase my operational expenditure to incorporate adaptation activities? The other thing is, I mean, the sooner you do that, the sooner you can actually look for opportunities and ways that you can actually reduce that expenditure. But the first thing is to actually understand as best as you can. Now, don't get me wrong, climate change provides an uncertain environment, but that's what a risk is. That's how you manage risks. It's about understanding what the potential implications are and then applying appropriate remedies to those particular implications. But the starting point is, okay, what right now do we consider the impacts to be?
Okay, so I suppose that leads into the next question about labelling and branding these activities as climate related. How do you go about it?
That's a good question, and to be honest, it's a question that is probably specific to the financier that you are looking to engage with. But because I mean, there are different standards out there that have differing requirements. Adaptation. If we look at the climate bond standard as an example. A lot of the climate bond standard, which has been used as part of the, which was utilised by the Queensland government when they issued their climate bond. A lot of the climate bond standard at this point in time is mitigation heavy. So there's a lot of information there around projects that are relevant, but more around the renewable energy space and reducing greenhouse gases and things like that. Certainly, adaptation activities are included, but there's not a lot of guidance. But I mean, that's about to change. There is guidance to be released for public comment in June this year. So we'll get a better idea about that as we go.
Yeah. And I suppose this is the follow-on to that one. Do you see this labelling as related or different to the existing betterment works, e.g. disaster prep mitigation? Like, are they any different, or is it just putting a different name onto the same activity?
Well, I think they're the same. I think where the guidance will be quite helpful is if there is a test around proportion, some sort of proportional test. So, if you're going to build a seawall, but now you're building it 50% higher than you were before, does that make the whole initiative an adaptation initiative, or does it make it a 50% adaptation initiative and a 50%, I don't know, just generic initiative? That I can't answer at the moment. As I say, I'm sort of looking forward to seeing these guidelines in June, have a bit of a better idea.
Okay, fantastic. Okay, and I suppose looking to more the investment side of it, in terms of lending money, will banks be less likely to lend money for investments in coastal hazard areas or areas?
Yeah, this one I responded to at the start, and I think so. We've covered that one. Yeah, it's bouncing all over the place, I think. We had a question, I think, around insurance. What was that? Because we've got a couple of minutes. Maybe I can address that.
Yep. What about? So what are the insurance implications for properties in climate hazard areas? Do you see insurance as changing significantly over the next 5 or 10 years for local government, especially?
Well, I think the insurance implications are potentially significant. I mean, we've already seen significant increases in insurance. I mean, if you look at Yassi and Larry and the impact on North Queensland premiums, back in was that 2010, 2011? I was overseas at the time, but certainly, there were significant increases in premiums subsequent to those events. I mean, to the point where, there are a number of government inquiries that were set up, like I think it was the North Australian Insurance Premium, Tribune or something along those sort of lines. The insurance industry has had a consistent message around maintaining affordability of insurance. And that is that if you want to maintain affordable insurance, you really need to mitigate the risk. The insurance industry can't do anything about the hazards, and neither can you. All you can really do is manage how exposed you are to those hazards. And from a pure commercial sense, premiums are what's known as a pricing signal. A premium reflects the risk that the insured event will actually occur. So the greater the risk that an insured event will occur, the higher the premium. So if there is a perception that particular areas are being whacked more than others, or we're seeing an increase in extreme tropical cyclone activity, even those areas which may not have been directly impacted, well, the insurance premiums will go up because they are also tropical cyclone prone areas. And really the only way to manage that is to mitigate that risk one way or another. I mean, even if you step back and if you look at local governments in North Queensland, I actually looked at this. I mean, my master's was mentioned before. I looked at the impact of insurance on a number of coastal councils in North Queensland. And what I found was, even after those events, certain local governments are actually starting to underinsure. Now, the budget for your insurance premiums may remain consistent, but the way that you manage that is you you incur a greater excess. So the amount that's actually covered is less. And I mean, and that's already happening right now. So yeah, I think there are significant insurance implications for properties in climate hazard areas. The only thing I would say with coastal areas is insurance doesn't really cover coastal hazards per se, like acts of the sea. So there's no insurers out there right now that will cover you for erosion or storm tide inundation or anything along those sort of lines. Certainly that I'm not aware of.
Yeah. Okay.
Look,
I think insurance generally is one of those topics that I think we probably need a webinar in itself, just to even touch on the surface. So hopefully we'll be able to get that moving. I think the last question that we had, like, I know that you've talked about green bonds, but I think I'd just like to talk about this one from Logan City Council about whether you've got any examples of councils that are actually accessing green bonds to fund projects or anything like that.
Not in Australia. Not in Australia. I think councils it would be very, very difficult for a council, certainly in Australia and certainly in Queensland, to issue a green bond. I mean, really, the predominant source of finance for local government in Queensland, I'll use Queensland as an example because that's most of the work that I've done, is the QTC. It's Queensland Treasury Corp. And that's because QTC has a AAA credit rating. It can access finance a lot cheaper than any individual council could. So, I mean, that will be the natural path. The other thing is, if you're a council and you want to go beyond the QTC, beyond the Queensland Treasury, you need permission from the Queensland Treasury to do that. And there's the SBFA, which, too many acronyms, which is essentially the Financing Act for local government, which has particular requirements around that. I think, though, that if you want to access the process or the proceeds of green bonds. So, for example, as I mentioned before, the Queensland government has already issued a climate/green bond, and those monies are being applied to climate/green initiatives as is required by the bond standard. So, if you want to access that sort of money, then I would imagine that's potential and a possibility in the future. I think maybe the LGAQ or the coastal, or was it the CCAT councils or something along those sort of lines, might want to start considering whether they want to bring that up with QTC and whether that's a potential form of funding in the future.
All right.
Sorry, Rod. One last. I know that we're breaking our cardinal rule.
Well, I mean, Rob did speak for 5 minutes, so if we want to give people 40 minutes,
I know that we have a cardinal rule about starting at 2 and ending at 40, but I just want to wrap it up with the final question, or just issue of just your final point, Ian, of what local governments should be doing right now to plan ahead financially for climate change. And just coming back to that, whether there's any key point that you just really want to
Well, I think that the first thing is, and I don't know who's in the various rooms, but the first thing is you need to get the CFO on board. You need to make it very clear that climate change, it might be an environmental issue, but it has significant economic risks. And I mean, there are many ways you can do that. I mean, one of the ways is potentially the slide, the second last slide that I showed, which just shows how seriously the private sector and the Australian financial regulators are taking this risk. I mean, that's the first thing. So you need that economic narrative, that economic justification. I mean, if you haven't already created that, and if the CFO is not already on board, then really what you need to be doing is you need to be understanding, and this I can't answer, and I mean, don't get me wrong, this is not an easy ask, but you've got to start somewhere. You really need to start understanding what the implications are of climate change for your operations and for your asset base. Once you understand that, then you can cost it. And then essentially you can incorporate the financial elements of what climate change is right now. Now, I mean, as I mentioned before, this is a risk. There's a lot of uncertainty. But, if it's if that seawall is going to degrade in 15 years as opposed to 20, but when you put it in place, you thought it was going to last for 30. Well, 15 is closer to 20. So, essentially, you're updating your understanding as you go along as the new science evolves, and you're starting to incorporate that in your financial planning. And really, as I say, that does more than enable you to understand what your financial implications are. It enables you to then set your own source revenue, per the requisite principles. And it also enables you to show, beyond the benefits that you're going to get from managing this risk in the first place, to show other entities that you are managing that risk, which could have, and as I say, I'll be very surprised in the next couple of years if that doesn't have implications on affordable insurance and debt, whether that's via QTC or whether, as an example, or whatever Treasury body, or whether that's directly to the market.
All right, look, that sounds like a good to end on. Ian, thank you very much for what I've certainly found has been a very stimulating presentation and exploration of some of the issues that are associated with the financial aspects of adapting to climate change. Just for everyone, we've got on line at the moment. Our next webinar in our series is being held in 2 weeks' time. It will be addressing community engagement aspects of the climate adaptation, certainly from the perspective of the organisation that I work for in my day job. But community engagement is where so much of the response to just about any social challenge is. I think it'll be a very valuable webinar to take part in. I guess just before we close, I would encourage everyone who has been on today to certainly continue to engage with the lab. We really do welcome further questions. We'd also particularly welcome any feedback on the webinar today, and also any suggestions for topics that would be valuable to include in our program going forward. We are working through the process of extending the series as we add new topics. So I think there's a lot more interest in and valuable material to come over the coming months. So, well, thank you everyone for your participation. Thank you, Ian, for presenting, and we hope to hear you back on another of our webinars very soon.